And my name is Bernard Jeter. I am the life and annuity specialist with Insurance Advisors Direct. And today we're going to present a pretty common annuity carrier, actually Standard Life. They've been around for a long time, but now they have an enhanced death benefit that is probably, one of the top benefits on the market today. So we're going to have our good friend Chris DeMars. He's going to go over that product with everyone. But first, we got to do our little commercial spot with Insurance Advisors Direct. And so who we are a full service FMO located here in Novi. And our main job is to simplify your success. And that's done by our 7 pillars of success. And those 7 pillars are our sales tools, our marketing services, technology, product offering, administrative services, training education, and lead generation. And all of that put together is what we use to help simplify your success. Now, on my end with the life and annuities, we're going to take that a step further with the 7 pillars. And we're here for, again, your product and education and training, carrier appointments, case analysis. We look over your case. If you bring that information to me, I'll run the illustrations for you. If I can't figure it out or need help, we have our good friend, Chris DeMars here that also helps with case analysis. Then our sales tools and materials, application creation and review, application review and submission, and then the whole business process and support. And that's what we do on our life and annuity side of Insurance Advisors Direct. And then at the end of the day, with all of your hard work and those that qualify, in April, last year we started our trip out. This year it is to the Dominican Republic. So guys, you have some time to get your life and annuity production in here, and it will definitely go towards your trip qualifications. So especially if you're a Medicare agent doing AEP, and then you need that little boost, definitely the life and annuities will definitely boost your standings up for the trip. So with that said, here I'm going to stop sharing, and then we're going to let Chris start his presentation. Go ahead, my friend.
All right, thank you, Bernard. Here, let me just get this up and running here. All right. Well, thank you again, Bernard, for having me on today for this webinar on the Standard and their new Enhanced Choice Index Plus annuity. As Bernard made mention to, the Standard's been around for a while, even though they're a relatively new company under the umbrella of companies that we offer here at True Choice Financial Group. They've been around since 1906. They were built on the foundation of life insurance, but now you'll notice today, if you've seen or gone to their website or whatnot, they don't even offer life insurance anymore. So they've totally diverged from that, and they do group benefit insurance, which actually there might be some life insurance that falls underneath that. They do some DI, some ESOP plans, and of course annuities, which we're going to talk about here today. Founded in 1906 in Portland, Oregon. 2016, they were actually purchased by Meiji Yasuda family, which is a Japanese company. It's actually the third largest Japanese insurance company, founded in 1881. So between the two companies, a lot of lineage there, a lot of history. I'm sure they've been able to figure out how to do things if they're still around today, being 1881 in the Yasuda family and 1906 in the Standard. Now, they didn't move headquarters or do anything like that. The Standard still headquartered in Portland, Oregon. The buyout was just an attempt for the USADA family to just broaden their portfolio and buy something that was in the US to diversify their portfolio. But then furthermore, get something that was on the West Coast, and the Standard was and is still to this day the second largest life insurance carrier on the West Coast of the United States. As you can see, ratings are strong as an ox. Standard & Poor's A plus, AM Best A. So you're not going to find a much better financial rated company in the business. So some of the new things that are going on over here at Standard with the new ECI Plus, they've added some growth options. If you're familiar with the original ECI contract, they did not have a capped option. It was all based on participation rates. And now they've added a new S&P 500 cap option along with a new index strategy as well, which we'll go through in pretty good detail there. They're doing daily sweeps. So before they used to only be able to issue business on certain days, and now they're doing daily sweeps on their index accounts. And they've added the Legacy Max death benefit rider, which Bernard touched on, which we'll get into as well. And I think it's one of the more compelling and stronger death benefits in the industry today. So if we look at the new annual S&P 500 cap strategy, you'll see that the caps are priced very, very well. Again, they used to have a lot of S&P, and they still do have the S&P volatility control options, which we'll go through later. But now they have just a straight up, no vol control, just straight S&P 500 annual cap option. As you can see, the rates here on the 5, 7, and the 10-year, pretty strong, 9, 9.5, and 9. You'll see the enhanced cap. Well, what's the enhanced cap? So you can pay a fee of 1.5% to buy up to that new cap rate of 12, 12.5, and 12 respectively on those options. And the new growth strategy that I mentioned before is the Bank of America Securities Global Megatrends Strategy or Index. Very unique. If you've been around long enough and you've seen some of the other vol controls in the business that tend to use your traditional asset class components, whether it's household or consumer or household goods as an asset class, or energy, transportation, those are kind of some of your pillars of different asset classes. This one's flipping the script completely upside down, and they're using 4 new thematic asset classes that are, I mean, I think it's too early to tell, but could be very revolutionary. One being robotics, the second being digital economy, third being millennials, and then they're using a disruptive technology component as well. And then for the fixed component, they're just using a 10-year US Treasuries future option. And if it gets so out of whack based on the 7% control, volatility control measure, as you see on the third bullet point there, they do have the ability to move to cash to lessen the blow of any volatility, extreme volatility that they may see in that. So Bank of America, well, whether you love them, you hate them, or you're indifferent, doesn't matter, doesn't change these statistics. One that really kind of jumps out at me is the 1 trillion in consumer deposits. So they are handling a lot of money. And for those of you who are a little bit more visual learners, here's kind of the overlay and how that process works. We start with the 4 thematic indexes, the robotics, the digital economy, the disruptive technology, and the millennials. We overlay that with that SALT financial true volatility risk control engine that's using 26 times more data points than what you'd see in your typical volatility control measure that other carriers are using. And so the idea behind that is that they're able to seek access to long-term growth opportunities. The second bullet point under there, that 90.4% hit ratio, what they're looking at, what hit ratio is how many times there's a positive outcome. So if you look in the very small print here, which I won't make you get your magnifying glasses out for that, they looked at June of 2006 through May of this past year, and found that on a rolling annual basis, there was a 90.4% hit ratio. So meaning 90.4% of the time there was a positive outcome. And as you can see, not just a positive outcome, but it averaged 9.9% average 1 year return. So pretty powerful stuff, even though I always like to put the caveat there that past performance is no predictor of future performance. So take it with a slight grain of salt, but hopefully with some of these new asset classes and so forth, and using that TrueVol, that SALT Financial TrueVol engine, that will help get your client some decent returns in the future. And if you want to break down, those 4 asset classes, you're going to find some names, Nike, Apple, Microsoft. A new one that you may not have seen too often, ChatGPT. That's definitely made some headlines in the last year or so. Quite a bit of talk about that, and just the whole idea of where AI is going. And if you look to the far right, we've got robotics, a couple of companies that I don't even have any idea who they are, but again, I think the idea behind this is using new emerging technology and asset classes to get some returns out of this index. And if we look a little bit closer at some of those back tested and live annual returns, you can see here it's done pretty well back tested, but anybody can kind of manipulate and put together things that they want based on past information, if you will, and data. But if you look at that far right here, now this is only through May 31st of this year, but already it's done year to date. Well, I shouldn't say year to date, again, May 31st, 10.5%. But talking to the folks over at the standard, even through to today, it is remains positive as well. So more numbers to throw at you here. Kind of gives you an idea, going back to 2013. The first 5 years, so 2013 to 2018, excuse me, the average rate of return, or the average 5-year rate of return is 14.93. The last 5 years was 12.17, and then the last 10 years was 13.54. I'm just using that middle column on the right side, and then of course we have that enhanced participation rate option. So for that 1.5% fee to buy up on the par rate, gets you squeezes out a little bit more juice. That's for you to decide whether the squeeze is worth the juice on that 1.5% fee. Jury's still out for me, but maybe it might be worth it on maybe, let's say, the S&P 500 annual cap option. Even though I don't have that data here, gives you options. And with that, here's some resources that you can jot down if you're looking to do some more digging, or you want to slice and dice to see, past performance and so forth. Here's the information that you need. So I'll give you a minute to write that down or screenshot it. Probably be easier. And I can always go back to that if need be. All right, so the enhanced choice index. So we've pretty much covered everything that you see here. 4.25 fixed interest account is something that I haven't mentioned yet. And then the other thing that I haven't mentioned here is the guarantee rates on the 5 and 7 year option. So let's take a closer look at that. And what do I mean by guarantee rates? I would say the biggest elephant in the room currently today in our industry is renewal rates. I don't think any company is immune to it. Every company's probably had their bumps and bruises as at one point or time or another, as far as how their renewals look. So one way to hedge against that is using the ECI plus on the 5 or the 7-year strategy. You'll see on the S&P Mark 5, the daily risk control, the ESG, and the global megatrends index. The par rates are guaranteed on the 5-year option and the 7-year option. So if you have had that awkward conversation on an annual renewal visit with your clients, that's kind of uncomfortable and may have gotten a little mud on your face, here's an option for you now that you'll never have to worry about that again. Because I know those conversations can be quite uncomfortable. And here's a way that you can guarantee the client that they never have to worry about the insurance company pulling the rug from underneath you. Not available on anything on the 10-year, and not available on the S&P 500 annual cap, as that's probably the most expensive option budget to buy there. But again, on everything else on the 5 and 7. All right, as Bernard mentioned, death benefit. So the Legacy Max Enhanced Death Benefit option will give you two options running simultaneously side by side, and that's even how they illustrate it. So the first option is they're going to give you a 6% compound interest. So you put $100,000 in, you're going to have $100,000 growing at 6% compound year over year. The other option that they're going to be calculating simultaneously is the enhanced performance option, which you're going to get 200% of your returns credited to your account balance. And so they'll have that running simultaneously along the 6% compound option. And what's great about this is a lot of death benefit riders usually will only go for X amount of years, let's say 10 years. And then that's all you get out of it, is what we've seen most commonly. Now with this Legacy Max DB rider, this is going to go for 7 years or the later of the client's 85th birthday. Again, whichever comes later. So for your younger clients, let's say age 60, this is going to go for 25 years until the client's 85th birthday. Now for your older clients, let's say, we haven't discussed this, but on this policy, it issues up to age 80. So if you issued it on a person age 80, it'll go for 7 years till age 87. So again, the later of 7 years or the 85th birthday. Cost. So for those clients who are 69 and younger, it'll be 80 basis points. Anything older than that, age 70 to 80, is going to be 1.2% cost for that death benefit rider. Okay. All right. So let's look. So there are some guardrails here, and this isn't new. There's been guardrails that have been put in place by most states on death benefits, whether it's in the form of a death benefit rider or any type of enhanced death benefit that comes on a contract. There are a handful of them that are out there. And on this one, the guardrails are, it's either going to be you max out at 125% of the surrender value, excluding any MVA, or the total premium accumulated at 10% annually, but not to exceed 250% of the total premiums minus withdrawals and all that stuff. I guess the layman's term with this, and what I've seen from all the illustrations that I've run, is you're probably going to run into the 250% of basically the account balance, really is what it boils down to. So you can't go outside that corridor of 250% of whatever the account balance is what I've seen. So I don't think I've ever seen the 125% of the surrender value come into play. It's basically the 250% of the account balance. Basically the states have banded together. There's there's a group, it's a compact group of states. It's about 44 states that are part of it, that have banded together to kind of streamline annuities and life insurance. And basically they all agree that anything above and beyond that's going to be considered life insurance. And so if you want that benefit on this, then it would have to be labeled a life insurance policy, not an annuity policy. So that's the justification around that. All right, so if we look at an example, as I mentioned, we've got the beginning year annuity value column, the end of the year annuity value column, then we've got our 6% roll up, and then we've got our performance enhancement value earning the 200% of the returns column. And then of course the death benefit base, which is, I don't know if you noticed it on the last slide, available as a lump sum. So whenever your client passes, that death benefit value does go to as a lump sum to the beneficiary. So we put $100,000 in, we get a 4% return. The account balance is 104,000. We get 106% on the guarantee roll up. The interest doubler gives you obviously double that. So 4 times 2 is 8. So you have 108 in that value. So year one, right out of the gate, not bad. Got better performance than the 6% compound. And if they were to pass year one, or right after year one, I should say, they'd have 108,000 to pass to the beneficiaries. Year two, well, we only get 1% return on the index performance. So we've got 105 in our account balance, still get the 6% compound, as you can see there, not simple interest. Otherwise we'd just be at a straight 112,000, but instead we're at 112,360. And then our doubler falls a little bit behind to 110. So now the 6% roll up would kick in as the better death benefit after year two. And so as we go along, year three, obviously minus half a point, can't get a minus, just going to get a goose egg. So we still have 110,080 in the performance value, but again, we get another 6% credit. And so that's taken a substantial lead there at 119. And so on and so forth. Continue going there. So at the end of 7 years, the 6% roll-ups at 150,000. And as you can see, we're still within 250% of our end of annuity contract year value of 122,398. So we don't hit that ceiling, and we're at 150,363. All right. So really, being that you have the 6% compound or that enhanced participation rate, really it covers 2 scenarios, which is dying too soon or dying or living too long. So it works in both scenarios. And I think we'll take a look at here. I don't think I have them in the slide deck, but I'll pull up the rates to see, you know, where this thing stacks up from some of the other annuity carriers it might be writing. But sales positioning, this is great for qualified funds, right? Because let's face it, when you got qualified funds, even though at age 73 is when you have to take your RMD, this will offset for the most part that RMD, right? Because, you know, us salespeople, right, we say it's about average 4% is what your RMD is going to be. Well, if you're guaranteed 6, what a great way to offset that, what they have to take out and maintain their death benefit. Because let's face it, at that age, if they're, you know, not taking income or using an income rider style product, they're probably looking just to pass this on to the beneficiaries. Here's a great way by adding the Legacy Max DB to the ECI Plus by using qualified funds. Let's see here, not a whole heck of a lot to talk about here. You know, double your money in 12 years. Obviously the rule of 72. So that would be 12 years it would take to double the asset. Put $100,000 in, 12 years later it'd be 200,000 guaranteed. All right. So we talked about some of this stuff here. No simple interest, no waiting period, no minimum age. Even though that goes without saying, you're probably not looking to write this on a 20-year-old. Max age is age 80. And then partial interest and roll-up credit, which is pretty cool. So if you're in the middle of the year and somebody passes, you'll get partial credit for that. And it's a lump sum payout option. Product comparison. Um, Here you have it. It's just comparing 6% compound to 7% simple, 8% simple, 9% simple. Nothing earth shattering here. What is nice though, and I'm sure everybody is waiting to hear, is what's the comp on this? And I'm glad to announce this is one of the more comp heavy products in the business, and by a long shot on the 5-year option. Well, on the 5 and the 7-year option. Street level on this, on the 5-year option, 5%. To kind of give you an idea, pretty much every other carrier that we use on a 5-year options, about 3.25. On the 7, pays 6. You're typically looking 4.5 to 5 on any other 7-year option in the industry. And then on the 10-year, a lot of companies are at 7, depending on whether or not you're doing an accumulation product or an income product. So again, definitely on the 5 and the 7-year options, extremely, extremely comp heavy. And as interest rates are, obviously the short terms, there's an inverse yield curve on interest rates. So we're seeing short terms that are better than the long terms. And as such, it reflects that on the rates with the standard. And I'll pull that up here in a minute to give everybody an idea of what they're looking at for rates. And if you want to go out there yourself, under the second one here for more resources, you'll see the standard.com/annuities/ECI plus. They don't have a PDF rate sheet that you can download. They just post everything on their website, and that's where you'll be able to find their rates at any given point in time. My number's up there if you need to get a hold of me. I think Bernard had his number up earlier. There's the contact information for sales support at the standard as well. What's cool about that, their website, it's not password protected. Only password protected if you're looking to get to some policy information and such, but just to run illustrations or get materials or sales tools or anything like that, it is not password protected. So you can go out there and get access to all the materials, and you don't have to get appointed with the standard. Now for the most lengthy part of the presentation, I'm going to read everything word per word for the disclosure. So hopefully I don't put you guys to sleep. I'm totally kidding. But let me see if I can slide over the rates here to kind of give you an idea. And I had them up. Here they are. All right, is everybody seeing that?
Yep.
Okay, cool. So here you have it. As I mentioned before, you've got the ECI 5 plus, the 7, which ticks up just slightly, as we noticed earlier in the presentation when I talked just strictly on the S&P 500 cap. It was 9 and 9.5 on the 7, and then it drops back to 9 on the 10. And again, that's because of the inverse yield curve on treasuries right now. You can get a little bit more juice on some of the shorter term stuff versus the longer 10-year treasury. And that reflects that way in the rates here. So being that as it is, I'll just probably stick here. Try to get most of this in here. So not bad. I mean, you look in S&P Mark 5, which has been around in the business for a while now. There's some real live data on that at 185%. 50% par rate on the straight up S&P, pretty darn good. I don't know. There might be a few other options that are at 50%, but not many. Many are still at 45%. So to get 50, so hey, client, you can get half of whatever the S&P does, no risk. Not a bad story. And then 50 notches up again to 52% on the 7-year, and so forth. So, and again, let me reiterate this, because remember, on the 5 and 7-year options on the pars, these are guaranteed for the contract, the life of the contract. So you may say, oh, well, company XYZ's, they've got volatility controls that are, 250% on a 1-year option. Well, that may be true. What are the chances that they hold it for all 5 years at that rate, or all 7 years at that rate? Probably slim to none. Here again, you don't have to take that risk, that renewal rate risk ride with your client, only to have the insurance company pull the rug out from underneath you. Again, these are guaranteed. The 5, all the par rates on the 5 and the 7-year. So please keep that in mind. All right, so with that said, that is the new ECI Plus 7, which just rolled out a few months ago and is available to everybody. The only states that's not available, and I don't think that's going to be a problem, because I think most people tuned in here are going to be in Michigan. There might be a few stragglers outside of Michigan, but the only other states that it's not approved in is Idaho, California, and New Jersey, and of course, New York. Otherwise approved in every other state. I don't know if you want to open it up for questions or how you want to handle that, Bernard, but I've got time, so
Yeah.
you call it, buddy.
All right, folks, if you have any questions, and for me, I think this is a pretty solid annuity, and, I think I'll offer it to my clients as an option as well, especially with the guaranteed part for the 5 and 7 years. Now, when you said for the length of the contract, so if it's a 5-year annuity, it's only going to be guaranteed for that 5 years. What if they decide to keep it? The money, will it extend past that 5 years?
No, all bets are off just for the guarantee period. So the surrender schedule of the policy.
Okay. Yeah, let's see what we got here. Oh, Andrea, thank you. Now, Miss Andrea, she's going to be a superstar here, Chris. She's new to life insurance and annuities. And actually, we were discussing one of her cases with the Allianz. So she's thinking that, but she has a lot of other clients she'll be. So she's going to be a superstar in the making. So
cool. Glad to hear it. Well, yeah. Any cases that come up, run them by me if you need my help.
All right, folks. I'm sure no other questions for Chris. I mean, like I said, this is a pretty solid annuity. The commissions are pretty good for that compared to other carriers in that same space. I think the other Lincoln Financial, they're pretty solid, but Standard Life beat their commission rates. If I'm not, yeah, they do.
Yeah. I mean, there's no other carrier that offers that comp on a 5 and a 7-year plan in the business. Period. Amen. That's end of story. So the comp is great. The product is priced well, as you can see, especially being able to guarantee the rates on 5 and 7 on the par rate options. 4.25 on the fixed account on the 5, 7, and a 10. So even for those folks that are thinking they want to do maybe go fix the first year, I mean, hell, you can't beat that. I mean, really, at the end of the day, indexed annuities are priced to do maybe in today's environment 4 to 6%, the way interest rates are. So you're on the lower end of that, but hey, it's guaranteed for the first year, and then you can reallocate the following year. So a lot of options.
Okay. And then for Medicare agents, when you are making that initial meeting with your clients, just let them know, look, thank you for your Medicare business, but here's other things that I do as well. So let's take a look at some annuity options for you. Let's take a look at some life insurance options for you. And with this standard product, it looked like it will take care of both needs. So yeah, that is something to look into as well, folks. So yeah, if there's nothing else, Chris, you have anything else?
No, that covers it. I'm excited
Yeah.
for the future, especially with this product. They definitely did a good job retooling it, and I think there's a lot of opportunity here with the standard and the ECI Plus.
Mhm. Yeah. So, folks, I'm gonna, of course, I'm gonna reach out to you after this webinar, contracting opportunities. And if you have any other questions about the annuity, just let me know, and we will go from there. And with that being it, Chris, again, thank you for always being a friend to IAD. We really appreciate it, folks. And you have a good rest of your day. All right, and a great Labor Day weekend. All right.
Thanks, Bernard.
All
See you
right,
guys.
take care, folks. Bye.